Hello. Welcome to the case 17-8 Justified Wages. This case has to deal with an equity transaction and the cash flow statement and how to present portions of the stock transaction. So first let's walk through what happened within the case. There are several transactions that Justified Wages, the company, went through in this scenario. So basically, they were trying to secure some financing from an independent investor called Well-To-Do Inc. They needed $40 million. Instead of taking out a loan with Well-To-Do, they went through a equity financing transaction. Therefore, they were able to secure $40 million in cash from Well-To-Do Inc. In exchange for the financing, Well-To-Do received from Justified Wages $30 million in Series E preferred stock and $10 million in shares of common stock. In order to have enough common stock without having to issue any common stock, Justified Wages repurchased $10 million in common stock from their employees at a per share price of $4.68. This stock was sold to Well-To-Do per the transaction above. So the $10 million that was repurchased from their employees is referred to as treasury stock. When a company previously issues stock and then buys it back, that is referred to as treasury stock. Justified Wages acted as a principal in both transactions with WTD and the employees. So what does this look like? What do these entries look like? I always like to put the entries together so I can have a better understanding of what actually occurred. So first we have the repurchase of common stock for employees. That had to happen first before they could issue that stock to WTD. So you'll see that there was a debit to treasury stock. Whenever you repurchase shares, that then reduces your equity of $7.4 million, and there was a debit to compensation expense for $2.6 million. You can see that the case included some guidance from ASC 718-20-35-7 that stated that the amount of cash or other assets transferred or liabilities incurred to repurchase an equity award shall be charged to equity to the extent that the amount paid does not exceed the fair value of the equity instruments repurchased at the purchase date. Any excess of the repurchase price over the fair value of the instruments repurchased shall be recognized as additional compensation costs. So what this means is that you had to fair value the stock at the date of repurchase. The company did that via an independent third-party valuation specialist, and they concluded that the purchase price of $10 million exceeded the fair value of common stock by $2.6 million. So this is why you see $2.6 million as the compensation expense, and then the value of the treasury stock was $7.4 million. And then the company paid $10 million in cash to their employees for the repurchase of that stock. Separately, they exchanged shares for preferred stock and common stock for financing from WTD. So they received $40 million in cash from WTD, and in exchange they issued their treasury stock in the form of common stock shares of $10 million, and then they also issued preferred stock of $30 million. So these are the entries that occurred for this transaction. So as a refresher on the cash flow statement, there's 3 different required sections: operating cash flows, investing cash flows, and financing cash flows. Operating cash flows are the day-to-day activities that generally involve producing and delivering goods and producing services. Investing cash flows are activities that include making and collecting loans, acquiring and disposing of debt or equity instruments of other companies, and property, plant, and equipment or other productive assets. Financing activities include obtaining resources from owners and providing them with the return on and return of their investment. So basically what this means is that investing activities are when you purchase or sell property, plant, and equipment, debt or equity instruments of other companies and then making or collecting loans. Financing activities are different because they specifically have to do with the company's own stock and also borrowing money and repaying amounts borrowed. Okay? So the key difference is that when you're talking about equity instruments, if it's the company's own stock, it's a financing activity. If it's a different company, it's an investing activity. And then debt and loans are included in financing activities. So question 1 of the case asks us to determine if the transaction for the $10 million paid to employees and the $10 million received from WTD should be presented gross or net in the company's statement of cash flows. So gross presentation of items means that each part of the transaction is shown as a separate line item on the statement. Net presentation of an item means that you can present the transaction net effect on one line item in the statement. This means that you would add the inflows and the outflows and just show one number as opposed to showing the inflows and outflows separately under the gross presentation method. The code has specific guidance about when it's appropriate to show information as gross versus net, which can be found in topic 230 in the statement of cash flows. So there's 2 possible answers to question 1 of the case. Gross presentation is appropriate or net presentation is appropriate in this case. So this is the first question that you'll be required to answer. Once you've determined if the information should be presented gross or net, you then need to determine how the transactions should be classified. Specifically, the case is asking us to determine how to classify the cash received and paid in its statement of cash flows. So the cash received is the $10 million from WTD, and the cash paid is the $10 million to employees. So if you determine that the information should be shown net, then there's only one alternative. It would all be shown as an equity transaction in the financing section. If you determine that the information should be shown gross, then there's 2 alternatives. One alternative is the portion of the $10 million that was recognized as compensation expense should be presented as a cash flow from operating activities, and the remaining portion should be presented as a cash flow from financing activities. If you're showing the information gross, you would know that the $10 million that was received from WTD should be shown as a financing activity because it was part of a financing transaction. The second alternative is that the entire consideration paid to repurchase the company's stock should be presented as a cash flow from financing activities. Specifically, you can refer to different sections within 230-10-45 for guidance. You're going to have to look at a couple different sections in that topic in order to make a determination about the appropriate way to classify the transaction. And then finally, the last question in the case asks us to analyze and come to a conclusion. Does the accounting analysis or conclusion change for each of the questions above when analyzed in accordance with IFRS? So basically, you're going to be revisiting questions 1 and 2 of the case and determining if the treatment under IFRS is going to be the same as or different from US GAAP. IAS 7 is the primary source of guidance under IFRS for determining how to present information about the cash flows of an entity within the financial statements. IFRS 2, paragraph 25, discusses the treatment of repurchased equity instruments. So you need to understand this first before you review the cash flow treatment under IAS 7. IFRS 2 is similar to the guidance that the case provides for ASC 718-20-35-7. I don't mean similar as in they say the same thing. I mean similar as in the guidance that's provided there, the IFRS equivalent would be found in IFRS 2, paragraph 25. Once you understand that, you would then refer to the following sections in IAS 7 to understand how to present the information in the cash flow statement. And you can see listed are 5 different paragraphs within IAS 7. I've updated the IFRS link within Engage in order to more appropriately reference the IFRSs instead of printing and posting PDF documents. So if you go to Engage and you go to the IFRS standards page, you'll see that first you need to register for the EIFRS Basic, which can be found here. Then the link to the IAS statements once you've registered, and you'll see that IFRS has the IFRS and IAS statements listed in two separate links. So the IAS statements can be found here, and they're under the unaccompanied IAS standards. So you'll see IAS 7, Statement of Cash Flows. If you're looking for the IFRS statements, it would be this link. And you could see here unaccompanied IFRS statements, and here's IFRS 2. If you have any questions about the case, please feel free to reach out to me. I'm also available after the executive lecture series on Thursday to answer any additional questions. Thank you and good luck.